Hey everyone, and welcome. Today we're going to break down two really important topics from the BAR blueprint: stock compensation and the financial statements of employee benefit plans. Now, you might think they're pretty similar, but here's the secret. The exam tests them from two completely different points of view. Getting that perspective right from the very beginning is going to be the key to unlocking these questions. Let's jump in.
So listen up, because this is probably the most important thing you're going to hear today. When one of these questions pops up on your exam, your first instinct might be to grab the calculator. Don't. Your very first thought needs to be, whose books am I working on? Are we talking about the company's accounting records, recognizing an expense on the income statement? Or are we preparing the financial statements for the benefit plan itself as its own separate entity? The answer changes literally everything.
So here's how we're going to tackle this. First, we'll dive into stock comp from the company's perspective. It's all about how they recognize that expense. Then, we'll get into the big one, the difference between equity and liability awards, which is a huge exam favorite. After that, we're going to make a hard pivot and look at things from the plan's point of view. And then, we'll wrap it all up by talking about risk and how to think about this stuff on exam day.
Okay, let's get started with stock compensation. So for this whole section, just imagine you're the controller at a big company. We are squarely inside the company's accounting department. Our job is to figure out how to account for paying our employees with stock or stock options instead of cash. So everything we're about to talk about impacts the company's P&L and its balance sheet.
The starting point for everything in stock comp accounting is this term right here: grant date fair value. This is the total cost that the company is going to recognize as an expense for giving out this award. And here's the absolute key for equity awards. This value is calculated one time, on the day the award is granted, and then it's locked in. It's set in stone. It gives us a stable, predictable cost that we can work with from day one.
But wait, the company doesn't just hit the income statement with that entire cost on day one. That wouldn't make sense, right? The employee hasn't earned it yet. This is where the matching principle comes in. We have to spread that cost, that expense, over the periods where the employee is actually working to earn the award. And we call that period the service period, or more commonly, the vesting period.
Let's make this real with a quick example. So Orion Tech grants stock options, and the total grant date fair value is $120,000. Now, to actually earn these options, the employees have to stick around for 3 years. So what's the annual expense? It's just a simple straight-line calculation. We take that total cost, $120,000, and we spread it evenly over those 3 years. That works out to $40,000 of compensation expense each year.
So for 3 straight years, Orion Tech is going to record $40,000 in compensation expense, and that $40,000 directly reduces their net income. But here's the part you've got to remember for the exam. No cash is leaving the company, not a single dollar. This is a non-cash expense that still drags down your net income. The journal entry is a debit to compensation expense and a credit to APIC stock options. Getting this expense without cash idea down is just absolutely crucial.
Okay, but what happens in the real world? People quit, right? What happens if an employee leaves before those 3 years are up? Well, the company shouldn't have to expense an award that was never actually earned. This is where forfeitures come into play, and it is a super common curveball the exam will throw at you to see if you can handle a change in estimate.
Let's go back to Orion Tech. We start with that original total cost of $120,000. But now, the company looks at its history and estimates that about 10% of these awards will be forfeited. So what do? We immediately adjust our total expected compensation cost. We reduce it by 10%, which brings it down to $108,000. Then we just spread that new, lower amount over the same 3-year period. Our new annual expense is $36,000. See? It's all about making sure the expense reflects what you actually expect to happen.
All right, you're doing great. Now we're going to add another layer. The accounting rules change depending on how an award is going to be settled. Is the employee going to get actual shares of stock, or are they going to get a cash payment that's based on the stock's value? This is the massive difference between an equity-classified award and a liability-classified award, and it completely changes the game. This chart really breaks it down. Equity awards, the ones settled in shares, are nice and predictable. Just like we saw with Orion Tech, their value is fixed on the grant date. But liability awards, the ones settled in cash, totally different beast. Because the company now owes cash, it has to book a liability on its balance sheet. And here's the key, that liability has to be remeasured to fair value every single reporting period until it's finally paid out.
That means the expense can go up and down with the stock price, creating a ton of volatility in the company's net income.
So how does anyone even calculate this fair value? Well, it's done using complex option pricing models. But relax, you are not going to have to do that kind of math on the exam. What you do need to do is recognize the factors that go into that calculation. Things like the current stock price, how volatile that stock is, the risk-free rate. These are all key drivers that determine the value of the award.
And one final point on stock comp. What happens when the employee's options are finally vested and they decide to exercise them? For an equity award, this is a pure equity transaction. That's it. The company gets some cash, it issues some new shares, and the entry only touches balance sheet accounts: cash, common stock, APIC. The most important thing to remember is that no new compensation expense is recorded. We already recognize all of that expense over the vesting period.
Okay, take a deep breath. We are about to make a huge shift in perspective. We're done with the company's books. Forget about compensation expense. We are now walking over to the benefit plan itself. I want you to think of the plan as its own little company. We are now the plan administrator, and our job is to prepare the plan's own unique financial statements.
Okay, so there are two main types of plans you'll see: defined contribution and defined benefit. Think of a 401k for a defined contribution plan. The employer's promise is simple. We promise to contribute a specific amount for you. Once they make that contribution, they're done. All the investment risk falls on the employee. But a defined benefit plan, like a traditional pension, is different. The employer's promise is to pay a specific benefit when you retire. That means the employer is on the hook. They bear the investment risk because they have to make sure the money is there no matter what happens in the stock market.
So these plans have their own set of financial statements. The first one is the statement of net assets available for benefits. You can just think of this as the plan's balance sheet. It shows what the plan owns, all its investments, at fair value. The second one is the statement of changes in net assets available for benefits. This is kind of like the plan's income statement. It tracks all the activity during the year: money coming in from contributions, earnings from investments, and money going out to pay benefits.
Let's look at an example. Summit Logistics has a defined contribution plan. They promise to contribute $30,000 for the year. So they write the check, they make the payment, and guess what? They're done. Their obligation is fulfilled. The company has no future liability. And from the plan's perspective, its financial statements just show a $30,000 contribution coming in. It's clean. It's simple.
But now let's look at Summit's defined benefit plan. This is a whole different world. The plan has promised its employees $200,000 in future benefits. But if we look at the plan's assets right now, they only have $150,000. That $50,000 gap, that shortfall, that is the employer's problem. That gap represents the risk that Summit, the company, has to deal with.
And that right there is the key connection for the exam. Because the employer is on the hook for that funding gap, the reporting and disclosure rules for defined benefit plans are way more intense. The footnotes are going to be packed with details about the benefit obligations and all the actuarial assumptions used to calculate them. It's all about making that risk, the employer's risk, as transparent as possible.
Okay, let's bring it all home now. We're going to tie these two different worlds together and focus on what really matters for the exam. It all comes down to knowing the perspective, the key focus, and who is holding the risk. Let's get this crystal clear. This table right here is your study guide. For stock comp, you're on the company's books. Your focus is on recognizing that non-cash expense, and the risk is to the P&L. For a defined contribution plan, you've switched to the plan's books. You're just tracking assets and changes, and the employee holds all the risk. And for a defined benefit plan, you're still on the plan's books, but the focus is on that huge future obligation because now the employer holds all the risk.
And hey, let me give you a quick exam tip. The questions you're going to see on the real thing will probably use messier, less rounded numbers than what we used in our examples. They do that on purpose. But don't let that throw you. The core logic for how you recognize expense and how you assess risk, it stays exactly the same.
So if you remember one thing from all of this, let it be this. When you see one of these questions on exam day, just pause, take a second, and ask yourself that one critical question. Am I on the company's books or the plan's books? If you can get that right, you are halfway to the correct answer. Because for these topics, the first step isn't about calculation. It's all about perspective. Now go nail that exam.